Vega is one of the most misunderstood option Greeks, but it's also one of the most important. If you want to know why certain trades explode in value when there's been really no movement at all, and if you want to start structuring trades that monetize market uncertainty like a pro, then this video is going to be your guide. In this video, we are going to break down what Vega is, how it behaves, and most importantly, at the end of this video, I'm going to show you how to use your understanding of Vega to structure unique option trades that drive huge P&L for people that really know what they're doing. Vega just measures how much an option's price changes when implied volatility changes by 1%. So if an option were to have a Vega of 1 and implied volatility went from 30% to 31%, then the value of that option contract would change by $1. We had +1 Vega, implied volatility went up by 1, and that means that our option contract increased in value by $1. That's pretty much it. That's how Vega works. It's literally a sensitivity gauge to tell you how much your option price changes when implied volatility changes. Think of it as measuring how much the market's expectation of future movement actually matters to your option trade. Now, here is the part that is crucial. If you are an option seller, then you are short Vega, meaning that your positions, they don't have this positive Vega like in our last example, they actually have negative Vega. So in this case, it's when implied volatility drops that you make money. And of course, that goes to say when it rises, you would lose money. All right, let's quickly talk about implied volatility. So implied volatility is the market's forecast of how much future movement there's going to be for a stock. Basically, it's what the market thinks is going to happen in the future. If IV is high, then the market's pricing in a lot of future movement. And if IV is low, then the market's pricing in very little future movement. And since options are priced based on that future expectation, a big change in implied volatility can cause option prices to expand rapidly or completely collapse, even if the stock itself does absolutely nothing. So when we look at Vega, we are just simply trying to be clear about how our option price changes based on a change in this future expectation. All right, let's do a quick example here, once again using our favorite ticker, Apple. Let's say that Apple's trading at $200 a share and you go out and buy a 200 strike call option with 60 days to expiration. You take a look at this call option and you see that it has a Vega of 1. Now let's say the implied volatility for this option when you bought it was sitting at 30%. All of a sudden, there's a rumor that a brand new product is going to come out that's going to drive huge sales for Apple, and the implied volatility spikes from 30% up to 40%. But also because nothing's actually come out yet, the price of the stock hasn't changed. What happens to our option in this situation? Well, IV increased by 10%, and we know that our Vega is 1, and this would mean that the value of our option contract increased by $10. If that option was worth $15, it's now worth $25, and that is how big of an impact Vega can have on your trade. It can cause massive changes in the price of options, even if the stock itself didn't move. All right, there's 2 key traits about Vega that you need to understand, and we're going to go over them right now. Number 1 is that Vega is highest at the money. What this means is that when the strike price you are trading is closest to the current price of the underlying stock, that is where you're going to get the most Vega. If the stock you're looking at is trading at $200 and you look at the 200 strike, it is going to have a higher Vega exposure than, let's say, the 160 put or the 240 call. The second characteristic, which is one that I really like to focus on, is that Vega increases with time. Meaning, if you look at a 1-day to expiration option versus a 100-day to expiration option, the option with a longer expiration is going to have more Vega exposure. That 1-day to expiration option probably doesn't have too much Vega because even if there's a change in future forecast, well, there's only 1 day left. Like, what matters is more what actually happens, the realized volatility. But if there's still 100 days to expiration, well, there's a lot of room for things to change regardless of today's movement. And so all of a sudden, we see that forecast of the future playing a much bigger role in the value of the option. So as days to expiration increases, so does Vega. Imagine we're looking at 2 people. Person 1 finds out that they have 1 day left to live. And person 2 finds out that they have 40 more years of life left. Let's think about what each of these people care about. The person with 1 day remaining really only cares about how today goes. Is today a good day or a bad day? If it's a good day, it means it was a good life. If it was a bad day, it means it was a bad life. There's only 1 day. But the person with 40 years left, whether today's good or bad, doesn't really dictate the outcome of their life in the long run. They are more concerned with, let's say, the trajectory that they're on. What kind of path are they walking? Are they getting to a point where they're going to be able to do the things they want in life? Are they going to accomplish their goals? There's a much longer forecast and consideration about where their life is going. And this is kind of how Vega works. A short-dated option is only concerned with what happens today, whereas a longer-dated option cares a lot more about the trajectory of things, the forecast of what could happen in the future. When implied volatility increases, the market's basically saying the future is more uncertain. And that's why longer-dated options change more in value. There's more time, and therefore it matters more what the view of the future is. So if you want to trade Vega, you want to be trading longer-dated options that are typically at the money, because these are the options that have the most exposure to changes in expectations of the future. They're not really as sensitive to what happens today, but you can bet that they're sensitive to what happens to implied volatility. All right, now that we know how Vega works, let's talk about that special trading scenario that I promised to cover at the start of this video. And I'm telling you, if you really understand what we're talking about here and go looking for these opportunities, you are going to find some really, really great trades. This is the general idea of the trade. When there is a stock that has massive short-term movements, think a bubble or a meme stock or an IPO that goes absolutely crazy, the market doesn't really know how to price the long-term volatility. And what ends up happening because of all this uncertainty is that the entire term structure just goes to the moon. Implied volatility across the board just skyrockets, and you can find situations where these longer-dated options become significantly overpriced. We're talking situations where the 120-day options could be implying like 10% a day moves. Now, in these situations, what are a couple things that we do know? Number one is that in the short term, things are probably still going to move like crazy. Why? Because as we covered in another video, we know that volatility clusters, meaning if there's big moves today, then there's probably going to be big moves tomorrow. But we also know that in the long run, things should calm down, go back to some sort of mean. And we know this because of that same video where we covered that volatility is mean reverting. Even if it goes really high for a while, eventually it comes down to some sort of long-term average. So in these situations, given our understanding of Vega, what do you think the optimal trade is? If you said going out to these longer dated expirations and selling volatility out there, you would be absolutely correct. The reason why I see these as the best trade to take in this scenario is because these longer dated options are going to have really, really wide break-evens, meaning that day-to-day movement, even if it's really high, is not going to really dictate your P&L. Instead, you are going to be exposed to the change in the future expectations of movement. Remember, right now, as this bubble happened or the IPO happened, everyone's panicking, everyone's freaking out, and volatility reflects that uncertainty. But as things start to calm down eventually, the people who are pricing these options also start to calm down. They start to get a little more realistic about the risk associated with this underlying. What happens in that case? We start to see the level of implied volatility coming down. And if you are short these longer dated options, you are short Vega. And if you're short Vega and implied volatility comes down, you're going to make money. I cannot overstate the quality of opportunities that can be found by looking at markets through this lens. The hard part about it is that these opportunities don't come around very often. You kind of got to pack on a bit of risk to make them worthwhile. And they aren't really something that you can just scan for. You kind of got to just have a little bit of a pulse on the market and take a look at what people are talking about. One signal that I use, and I have a scan built for this in the Predicting Alpha terminal, is what I call my distressed volatility scan, where I basically just look for tickers where the level of implied volatility is at its highest across the entire term structure. So if there's an IV rank of 95 for all the expirations on the chain, then I know that something's happening here where people are expecting a lot of movement for a very long time, and there's a good chance that people might be overreacting, and that's something I want to look at. All right, this has been a long video. We've gone through every detail that I think is important for understanding Vega and actually applying it to your trade decision-making. So let's just bring it home now. Let's do a wrap-up here. Vega measures your sensitivity to implied volatility changes. If you're selling options, then you are short Vega. Vega is highest at the money and on the further dated expirations. When you're trading long-dated options, the Vega dominates. And when you're trading short-dated options, Gamma and Theta are the ones that matter more. Some of the best trades can be found when implied volatility is inflated across the board. If you want to be more than just a chart reader, and you really want to understand how volatility trading works, then you got to know how Vega works. Hopefully this video opened your eyes to some of the possibilities that are out there when you understand your Greeks. And if you're starting to structure trades using Vega, grab a free trial with Predicting Alpha and use our scan to try and find some of these opportunities. So with that being said, we'll see you in the next video. Happy trading, everyone.